The stock market this year has mostly been defined by AI stocks and tariffs, meaning the stocks that benefit most from avoiding those tariffs. But interest rates have fallen. There's a 97% chance, according to some, that there are more rate cuts coming, and that is going to benefit a certain class of stocks. So, what stocks are those, and what are the best stocks available? Let's go ahead and break it down. Those are finance stocks. Now, the general thinking here is that when you cut rates, the entire stock market generally benefits, but especially finance stocks. For banking stocks, you lower rates, they can loan more, and that's going to help them to make more money. If you are an asset manager, generally stock market goes up, and that's going to help them and the assets that they own. That's the most basic, elementary answer that I can give you in 5 seconds, but all of these are stocks that you can add to your watch list, research a bit further, and see if they fit for your portfolio. Let's go ahead and start. The first one is State Street. The stock symbol here is STT. It is up 44% in the last 6 months and up 26% over last year. They are an asset manager. You'll notice that in the finance category, I think most people think banks, but on this channel, we expand that definition. We're talking about asset managers, insurance companies, banks, and others. We won't see the insurance companies today, but I do have an affinity for insurance companies. They apparently ain't making enough money to be on this list again today. Northern Trust, which I believe is a stock that we had talked about probably last month. NTRS is the stock symbol here, up 43% in the last 6 months, up 39% in the last year. You will notice here that, especially if you're looking at a chart, a lot of these will be better in the last 6 months than over last year. And I think because of those cuts, a lot of these have accelerated in that growth. Now we will see whether that growth is going to continue, but you'll notice like, hey, these companies weren't doing all that well, and then all of a sudden they started to kind of get a shot in the arm, and now you are starting to see why. But Northern Trust, NTRS, add it to the watch list, see if it fits for you. Then you've got Invesco, IVZ. You've likely seen those commercials. QQQ is one of their most popular ETFs. 83% gain, which is wild. Wild. 83% gain in the last 6 months, up 31% over the last year. Bruh. Okay, that is crazy. That's why I really want to dig in a whole lot more into, because yeah, I understand the interest rate cuts and all that kind of stuff, but an 83% gain for a company that I'm maybe it's a household name, maybe it's not, but that's a lot. That's a lot for what I would consider a quote non-tech company. I don't think it's getting enough attention. I feel like something else has to be going on here other than just the rates, but very interesting, and a company that is absolutely going to be near the top of my list. For those that don't know, I always make changes to my personal portfolio in June and December of every year, and I start to collect notes. And this is one of those notes that I'm collecting to see what's going to make it into my portfolio. So Invesco is going to the top, to the absolute top of that list, and we'll be tracking this one to see what's going on and doing a whole lot more research here. KKR used to be the asset manager that was there. Invesco might replace that. KKR got kicked out a while back for reasons. So we'll see if Invesco is going to be that new one. Now we move more into some of the household names that you do know. You might not know their performance. The first one is Bank of America. Bank of America is up 41% in the last 6 months, up 21% over the last year. I don't need to explain the business of Bank of America. I'm pretty sure you know it. The next one is also a household name that I don't think I need to explain what they do and how they do it. And I think these two are the most logical in why lower interest rates will help out these banks. And that's JP Morgan. JP Morgan is up 31% in the last 6 months and up 44% over last year. Of all these, it's Jamie Dimon, perhaps the most famous, most stable CEO, depending on your definition of stable, I suppose. But he's the one where people know and kind of go to him for economic guidance in terms of what's going on in the U.S. economy. I guess he's the most qualified, depending on how you want to view him in general, but depending on how you want to view him and his expertise. But If you're looking for good, solid management and I guess consistent performance, then I guess JP Morgan would be the one. If you are looking for gains, then I would probably look for Invesco. But obviously, it's the stock market. Nothing's guaranteed. And as we have seen over the previous weekend, a tweet can shake up everything. So you want to have a long-term approach is what I would look for. And obviously look for diversification, which means you don't want to just have a whole bunch of finance stocks. Okay, an index fund might make sense. Some gold might make sense, and some index funds, some international funds might make sense too. If you want to know how to acquire those other assets as well as other things about investing, you want to check out these videos right here.